Hello and welcome to Equity Merchants on Business Front TV, the show where we track the capital flows shaping Africa's tech, finance, and energy landscapes. I'm Chimgozrim, reporting from Lagos, Nigeria. Here's a look at the major headlines making waves across the continent. African Development Bank approves $184 million for solar project in Egypt. Move seeks $300 million for vehicle financing. Nairobi Securities Exchange posts record numbers. The African Development Bank has just approved $184 million for the Obelix solar project, a 1 gigawatt photovoltaic power plant paired with a 200 megawatt hour battery energy storage system. Located in southern Egypt, the $590 million project will feed into the country's national grid and is expected to begin operations by late 2026. Once live, it's projected to generate more than 2,700 gigawatt hours of energy annually, enough to power hundreds of thousands of homes. Under a 25-year US dollar denominated power purchase agreement, the Egyptian Electricity Transmission Company will be the sole off-taker, giving the project long-term revenue certainty. Move, the vehicle financing startup for ride-hailing drivers, is back in the funding race, and this time, it's gunning for $300 million. The Nigeria-founded company, which made headlines last year after raising $100 million and bringing Uber onto its cap table, is reportedly in talks with investors once again. That earlier round had valued the startup at a reported $750 million. Move has grown aggressively across 3 continents, helping ride-hailing drivers in cities from Lagos to Sao Paulo own and finance vehicles. It also recently acquired Brazilian mobility startup Covi in a deal that expanded its footprint in Latin America. The company says its revenues have now surpassed the $300 million mark, signaling strong demand for its asset-backed lending model. The Nairobi Securities Exchange is on a record-breaking run in 2025. All major indices at the NSE are now showing double-digit gains year-to-date, with the all-share index jumping more than 19% since the start of the year. That index alone is up over 73% from its October 2023 lows. This week has seen a rare 3-day winning streak, with the NSE all-share index posting gains of over 2% for 3 straight sessions, something witnessed only once in the past decade. Leading the charge is Safaricom. The telecom giant briefly crossed the 1 trillion Kenyan shillings valuation mark on Thursday, a milestone it hadn't hit since December 2022. Shares hit 25 Kenyan shillings before settling slightly lower, but still up more than 46% year to date. To put that into perspective, Safaricom's market cap is greater than the combined value of all listed banks and insurers on the exchange. We're almost halfway through the year, and African startups have already crossed the $1 billion funding mark. The year kicked off with a bang, $289 million raised in January alone, but momentum cooled in the following months as global markets remained cautious and capital remained selective. So what's fueling the recovery, and what does the road ahead look like for African founders? Joining us now is Ayobami Olajide, Senior Associate at Endeavor Nigeria, to unpack the trends, investor sentiment, and what startup funding could look like by year's end. Welcome to Equity Merchants, Ayobami. First question I want to begin with is the funding trends that we are seeing. This is about 5 months into the new year, or into the year, and we are seeing some progress compared to previous years. So what are some trends that you're noticing?
Right. Thank you so much for having me. Happy to be here. So like you rightly said, this is 5 months into the year, and it's a good time just before half year to kind of take inventory of what has happened in the venture capital asset class. So far, one of the biggest directories that actually tracks funding activities within this asset class currently has about 227 deals that have been done. I've done about over $1 billion in funding activity, and those monies have actually flown into the usual suspects in terms of investment destination. So we're talking Nigeria, Kenya, South Africa, Egypt, and Ghana, right? And they're flown into verticals that are the usual suspect, but maybe newer trends are coming up within the sub vertical. So normally fintech, but there's now increased focus on stable coin plays and remittances play. Cross-border remittances continue to shine through. in those subverticals, right? 227 deals done. It's actually a better tracker, a better uptick from past funding years. And then some of the trends I'm seeing beyond like the usual descriptive analysis of the verticals or the geography is things around the fact that growth stage deals are continuing to drive these funding numbers, right? We have deals like, Lemfi's $53 million Series B. We have deals like Money Point's $10 million deal, and a couple of others, right? We are seeing that this growth stage deal, and they're also consistent in every market that has, led these funding rounds in Nigeria, in South Africa, in Kenya. So these big deals are actually the ones that are leading, that are holding the numbers up in their respective markets. That's one trend. Number two trend is the fact that there is also I don't know. It's very interesting to see that there's increased talk around, climate adaptation, and then 25% of the 227 deals are actually climate tech deals, right? And they were seeing some sort of exit as well happening in that space with the BioLight acquiring Baobab Plus, and a couple of others. So just on that note, I'd like to also zero in on the issue of exit. So exit has always been a contentious topic in the African tech ecosystem, right? Exit how we show the viability of the ecosystem, the viability of the maturity of startups. If so much funding has been poured into the ecosystem from 2020, 2016 up until now, this exit kind of showed that there is something to double down on, right? It's also a means by which we return capital to the earliest believers and the investors in this company. So the kind of exit that we've seen that I think would be very interesting is number one, there's actually a particular transaction I'm excited about. It's happened in Egypt. Well, value listed on their domestic stock exchange about 25% of their stake. It's actually something that's interesting because when you think about startups that have typically gone public in the past. We have them on the Nasdaq, that's Jumia. You have them Karim, like Jumia particularly on the Nasdaq or the New York Stock Exchange. But we're having a situation where local stock exchange can also enjoy part of this venture sophistication. So as we think about building businesses, one of the major advocacies is that can we get to a point where most of the economic outcomes that are actually enjoyed are trapped in the local economy. So that transaction is particularly helpful. We've also had some other species of exits that are interesting, like when Baobab Global bought their stake in Baobab Nigeria and then gave Alithia and Goodwill Investment like a good return. We've had like different transactions, like the Spark transaction. I think there was also a Spark transaction also in Egypt that is worthy to note. And then we had many transactions of the like of Wasoko acquiring Fatura. And then this kind of transactions are really interesting because it shows that a lot of these growth stage players are actually consolidating, right? They are consolidating, they are buying players that are building in adjacent markets or just near verticals that can help to strengthen their market position. You find out that even Lemfire as well acquired some, and these acquisitions may be in some sort of way like a way to also strengthen their regulatory position so that they can serve customers better. MoneyPoint just announced that they're buying like 67% of a Kenya MFB. We've had cases where a company like Lemfi also acquired an Irish player. These sort of acquisitions will continue to happen among the big players, and it's very interesting to see like the sophistication that is happening within our markets. We hope that more big or growth stage players can actually continue to do more. On that note, I would also like to make make a very quick point around what is also happening within this exit. So a lot of people have termed the venture capital equity as an illiquid asset class, but we are seeing that with this growth stage funding, with this momentum that's following growth stage investing, it's also seen that there is a lot of secondary activities in the secondaries market, right? We've had a case where early employees are, cashing out on their equity, or their equity is actually becoming cash real time. We had good news from Money Points. We had some cases from Energy as well, and from more of these companies that are actually going for later stage transactions. So not just to be more of a fan of the growth stage, because from a career perspective I kind of focus there, but from the early stage as well, we're seeing a lot of trends where the companies that are raising capital are showing much more mature, funding profile, or much more mature traction profile than before. You find companies that are closing like Accrue, a stablecoin play, Carrot credits, that they do some sort of securitized lending with your digital asset and stuff like that. Raised about 4.2 seed. I think those are really, and Construct as well, another company that comes to mind, building a marketplace for construction materials. You see that these companies that have like a very mature traction profile, and that is putting them on a stronger note to actually go and raise. One very last point, actually, that I think will be very useful for everyone who is observing the trends in the ecosystem is that founders are beginning to, they're more inclined to, getting applying the blended capital approach, right? And what do I mean by that? Is like people are more inclined to taking debts now, instead of taking equity, there's more focus on debts and all that. And it also speaks a lot to the maturity of the business itself. Startups are seen as risky ventures. Startups are seen as ventures that you don't really want to back because the business model is unsustainable, the cash flows are still iffy and all that kind of stuff. But we're finding a situation where startups are actually listing commercial papers and they are being oversubscribed. And that is very interesting because the bar to listing a commercial paper is really high in terms of you have to have good credit rating and all that. We had cases where Fair Money rather, Fair Money listed the commercial paper, CredPower had the commercial paper, Sycamore had the commercial paper about 1.5 billion. And they just concluded a series just recently, and then AgroEcno also had like commercial paper that was oversubscribed. So debt is also something that founders are looking forward to. Currently when the MPR is very high, bank loans can be as high as 40%. So people are moving to commercial papers, which actually offers like great fixed returns for investors while still, helping to fix their working capital needs. So I really think on many sides, we are seeing an ecosystem that both the investors and the founders are actually beginning to be on the same page as regards building sustainable business, strong unit economics, and that is allowing them to explore different kind of options from, equity capital raises that are much more reflective of our economic position or their future potential in terms of, capital strategy, and then exploring debt as well. So the opportunities are really bright, and I think that I'm more optimistic about this outlook. Is reflects realities than previous era of the ZRP, zero interest rate policy, and then just the pre-COVID eras. More sustainable businesses will come out of this sort of capital climate than before.
Yeah. Okay. So those are like a lot of positive highlights. But something we've seen compared to last year is that we've seen very few VC raises this year. I think we've even had one VC in Ghana shut down. So how significant do you think this is for the larger ecosystem? How, like, for the broader funding environment, how significant is it that we are seeing less activity from VCs just raising new funds?
I think it's really a hard time to be an emerging fund manager, right? You raise funds. When you raise a fund, the expectation is it's not a charity, right? A fund has if every fund has a mandate to return capital to its investors. If you raise the first fund, let's say a first fund with a vintage year of 2016, or the vintage year of, and vintage is like the year you actually started operation. It's like you raise a fund, let's say 5 years ago, or 6 years ago. That's enough time for your current crop of LPs, limited partners, to actually assess your portfolio. When they're looking at a portfolio and they're saying that this is a portfolio where, 80% of the companies are default dead, and then the remaining 20% are probably neither, they would not give you venture scale returns. So there is actually no confidence in actually giving you money for a second fund. So that's on one point, is like the quality of deal flow or the quality of portfolio for existing fund managers actually would determine the ability to raise subsequent funds. And you would agree with me that even in the midst of this slow climate to actually raising capital, right, or raising new funds for emerging managers, which is across the world. Companies like Lofty Inc. raised a new fund, $43 million, and there are also other fund managers that are closing bigger funds. Ventures platform also closed the fund, and then even within this, so it's for fund managers that actually have an existing fund, they would actually raise subsequent funds on the strength of their current portfolio, which would help limited partners to see that, oh, hey, there's actually a method to these things. You can actually pick winners, right? There were case studies of companies. There was a company, Silverback Holdings, right, that showed that they had like some return, some X on one company, and then in the next week they had also 5X on some other exits. So those sort of exits, these conversations we're having about exits, would play in the favor of the fund managers that actually invested in them, right? It will help limited partners to know that, oh, these are the funds that are actually performing. It's an asset class, like, and with every asset class, there is actually examination, right? I do hope that at some point our ecosystem will get to a point where we have some sort of a came. It's is it there is a I'm trying to remember the name, but there's a body that actually assesses fund performance for different funds in America, or global north, right? So I hope that we have that kind of fund benchmarking for Africa or for Nigeria, so that for Africa, since we're talking about Africa, so that we can know what are the top quartile funds. But currently, the way we know top quartile funds are just, you just go through their portfolio, and then you look at, what's the percentage of this portfolio that is actually dead, what's the percentage of this portfolio that are actually outliers in their respective industry. There are some funds that have done immensely well in actually picking some of these companies. Some other funds have not done, they've not met the bar for the venture scale returns, like there's having just enough investment. They may have one investment that exited, but that's not a critical mass to actually return investment to return capital to investors. It's not really and we have a saying is that what really matters is how much you return to investors. That's the DPI, the money that lands in the bank account of your investors will determine if you can have, enough money for a second fund or a third fund. But for emerging founders, I think it's just more around the macroeconomic situation. A lot of people are parking their money in fixed income, right? This is a fixed income market currently, even for across different asset classes. When you have a fixed income giving you about as high as 31% or 36%, right? That's 36% year on year. And then some of these commercial papers, and it's really hard because capital actually has trade-offs, right? What the money they're not putting in venture is money they're putting somewhere else, right? So it just needs to show that these returns are attractive enough to inspire investor confidence, right? And then with some of this exit activity happening around, the mature and the growth state companies, is actually going to fuel a lot of, it's going to fuel a lot. It's going to trickle down into making sure that emerging founders have like the fund that will be the feeders for more growth stage companies in the African ecosystem. So that's the way I see it. There's a macro side to it, and then there is a fund of fund perspective. But regardless, we've had like a lot of funds actually raise a second fund. So, but these issues are a lot more nuanced than just saying is an African thing. So there is a macro, and then there's a just case by case basis assessment of it.
Okay. Thank you so much for your time, Ayobami. This was a very insightful conversation.
Thank you very much.
Nigeria is making headlines in the debt markets, this time with a record-breaking Sukuk issuance that far exceeded expectations. In May, the country raised 2.2 trillion naira through a government-issued Sukuk bond, a non-interest Islamic finance instrument. Originally targeting just 300 billion naira for infrastructure funding, the offering saw overwhelming investor demand. According to Nigeria's Debt Management Office, the oversubscribed bond attracted a wide pool of subscribers ranging from retail investors and pension funds to non-interest and conventional banks, as well as asset managers. Today on the show, we sit down with Benga Mababeola, MD, Sycamore Investment and Asset Management Limited. He shares insights into what made this sukuk so attractive to investors and what it signals about Nigeria's broader borrowing strategy and investor appetite.
Based on everything that's happened so far this year, can you tell us what the public markets is looking like? So everything from bonds, we've been seeing the different treasury bills, euro bonds, and Islamic bonds, and all of that. So can you give us like a lowdown of what's going on out there right now?
Well, yeah. So it's been an interesting year so far. We're in the middle of the year, So going into the year, there was a lot of positive expectation from the macro environment, and that was expected to filter through. And I don't think there was any disappointment really in terms of how, the FX situation panned out or is panning out for the year. There's optimism. Interest rates are still high, more or less on the high side because MPR is still 27.5. That's impacting fixed income instruments and treasury bills and bonds. Those bonds currently this year are running at about between 18.5% and 19%. Coming from last year, it's still on the high side. So there's been a lot of activity based on that. So just like you mentioned, there's been issuances from the beginning of the year, treasury bills, bonds on a monthly basis, and even more recently, the Sukuk bond that you talked about. That was an interesting one as well because we got a significant level of subscription. It was subscribed up to about 2.2 trillion thereabout, compared to the issue offer, which was about 350 billion. That's significantly higher. So there's a lot of activity, there's a lot of liquidity in the system. So that's kind of a catalyst for more trading volumes in the markets.
Interesting. Now, I've talked to a number of people in the financial services space, and a lot of people don't understand what the Sukuk bond is all about. Like, how does it work? And I'm even surprised people knew enough about it to even oversubscribe. So can you tell us, just let us know what the Sukuk bond is all about?
Yeah, that's an interesting question because, I wasn't surprised. I think most players who've been in the market will not be too surprised with the level of adoption and subscription levels, particularly because in the Nigerian market, the Sukuk bond as an instrument is relatively an emerging asset. I say so because while there's been Sukuk instruments issued in the past and previous years, it's been in limited supply, really. So compared to traditional bonds, for example, that are issued every month. Every month from January to December, there's a calendar for bond issuances, traditional bonds. Sukuks generally have been issued by the federal government in special cases where they want to finance projects, road projects, general assets. So that has been in limited supply. And if you now think about the demand side of that instrument, which is Sharia compliant investors, they are thirsty for those kind of products. Those monies will not go to traditional bonds, for example, because of riba. It's against their Sharia religious allowances. So when there is a Sukuk issuance, there tends to be a lot more demand, a lot more subscription. All of that money comes out of the closet and tries to plug in. So when the subscription level came out, the record, I wasn't surprised at all.
Interesting. So what makes it special? Like, what makes it Sharia compliant, and if it is Sharia compliant, what makes it interesting for people to say, let me do this and still get returns from it? So how does it work?
Yeah, so again, good question. I think just tailing the previous question. So sukuks generally they're similar to traditional bonds, only that they are, like you said, they're Sharia compliant. And Sharia compliant just means they are in line with Islamic laws in terms of ethics, ethical investing, based on Sharia law. Sharia law is basically Islamic law. What are those things that makes it compliant? Those are things like, banned or disallowed activities like gambling, like prostitution and racketeering, alcohol, banned food substances like, pork, for example, in Islam. All of that put together, there's more, all of that put together kind of gives a framework for ethical investing. And you're looking at it through the lens of, Sharia, which is Islamic. So if you think about it generally, you'll see that it captures a wide range of investors, both Muslims and non-Muslims who want to invest in an ethical manner.
Okay, so if the market is, say, down and lots of volatilities in the market, are you going to get more interest in something like Sukuk bonds, or is Sukuk bond just going to just be this way, whether the market is booming or not? Is this par for the course, basically?
Okay, so your question is if the market is down, for example, and other asset classes are impacted, how will Sukuk perform, right?
Yes.
Yeah. So first of all, just like I talked about, the level of demand in Sukuks already, that generally feeds through. The fact that there's a lot of that segment of investment funds that are seeking things like Sukuk, that will impact even market upsides and downsides. So if there's a crisis, for example, a financial crisis or economic crisis, Sukuks will generally hold up when you compare it to other traditional assets like bonds. Mainly because, number one, I talked about demand. Number two is that Sukuks are generally asset-backed. They're issued to finance projects. You'll see if you drive through Lagos on the island, you'll see some pillars where they actually even inscribes the name of the Sukuk that was issued to finance the project. So they're actually financing for actual projects. That means that, whether there's a downturn or not, there are real assets that are backing those transactions. And more often than not, those transactions actually, or those assets, pay for themselves. The other thing is the fact that most of the time, the institutions that issue Sukuk are very high quality. Like, governments, for example, the federal government issues Sukuks. Large corporates also issue Sukuks. You hardly see small SMEs going into that because of the high risk and market volatility that affects them.
That's interesting. Now, if we're going to look at it, you mentioned that the public market has been booming, a lot of activity and all of that.
Correct.
Do you think it's sustainable? Do you think this is just a symptom of the broader economic environment? People are looking for how to make money, or is this a systemic shift? Do you think this is going to be a long-term thing? Is this going to be sustained in the future?
I want to believe, and even from the data that we're seeing, I'll look at it from two sides. I think there's a lot more awareness for Sukuk, even though it's relatively young in terms of issuance in the country. More people are aware of it. More people looking for ethical investing are aware of it. You can easily walk into an asset manager like Sycamore, for example, and ask for an instrument like Sukuk, or any other asset, and you get, a response, you get an offer or something like that. This is different from the way it was in the past. It wasn't very well known. There are more Islamic financial institutions now. There are Islamic banks, there's Taj, there's Jais, all of that. So there's more awareness for investors. There's also the side of liquidity. So in recent times, you will have heard that there's a lot of system liquidity. There's money supply. There's an increase in money supply in Nigeria right now. That's been the case this year so far. That has spurred trading activities in fixed income. That has spurred all that significant bids for these instruments as well. So in the near term, I mean, for the foreseeable future, at least for this year, going into next year, that liquidity will play out. You know, the fact that there's money in the system that is really looking for where to park in terms of investment. So this, in my opinion, it's going to be sustainable.
So there's money in the system, and we're all complaining.
There is there's money in the system, apparently. Yeah. There is money in the system.
Interesting. So do you think a lot of education, do you think the public is well educated enough to be able to leverage these opportunities? Because the Sukuk, there are other fixed instruments. For instance, I didn't know, I was on TV some weeks back and I was complaining about how I didn't even know my bank had like some of these investment instruments that I could actually leverage. No one said, hey, you could actually do this. So do you think there's enough education going on for the public to actually make well-informed decisions on things like this? And what can be done?
Yeah, so you're definitely right. There's a way to go about investor education about assets like Sukuk that are just coming up. So if you compare it with other assets, there's not enough coverage for Sukuks. Again, because it's ethical investing, most people are used to, you know, I want to buy a bank, I want to buy banking stocks, I want to buy CPs from whatever industry. But more specialized assets like Sukuks, because it's an emerging asset class, the coverage is a bit limited for now. So we have institutions like, you know, Sharia advisors who actually advise on these transactions. They are populating the market now. Again, because it's emerging, we're having more corporate players who are actually contributing to investor education. That will improve, and I think that it will improve with more Sukuks that are going to be issued in the future. That situation with investor education and awareness will improve. But I mean, the situation right now, if you compare it with traditional assets, definitely needs a lot more work to be fair.
How about traditional assets? Do you think there's even enough
of
that?
I mean, again, that will also depend on demographics. So, you know, older people who've been investing in shares or investing in T-bills through their banks are probably aware of you know, assets and investing. Again, it's also limited to, you know, some class of investors. Retail investors are generally excluded. Yeah, so there's still the gap even in, and you're right about that, there's still the gap even in traditional assets. But if we compare it with specialized assets like Sukuk, there's still, I mean, the gap is still wide. So generally speaking, for assets and investing generally, there's room for improvements for investor education, you know, much less for Sukuk as well.
So to be clear, anyone can actually leverage Sukuk. It's not just limited to...
That's the interesting thing about Sukuk. Sukuk, you know, I even forgot to mention, Sukuks are kind of tailored for even retail, because if you want to invest in a federal government bond, for example, you need about 50 million naira. Minimum, yeah, to invest. And for Sukuks, the way it's designed, if you even look at the last Sukuk issuance, if you have 10,000 naira, you can actually invest in that Sukuk. So it's tailored, it's structured and tailored to all classes of investors, from retail to institutions as well.
Okay, and I don't have to be Muslim to be able to leverage it?
Absolutely not. You can be an atheist even if.
Okay.
But it's all about ethical investing, just backed by Sharia laws.
Okay. Yeah, that's very useful to know. I just need to get it clear for the audience. Okay, this is something that anyone can leverage. I didn't know it was even as low as 10,000.
Yeah, 10,000. I mean, it's a very good way for even the institutions who are working on this are, and I think that, you know, it's impressive that they're even looking into the future in terms of making those instruments attractive for all sorts of all classes of investors, even foreign investors, you know.
That's interesting. Now, while I was doing my research, I was searching the internet and I saw things around. Again, this sounds like classic startup, being unnecessarily futuristic, but I was seeing things around using blockchain to improve Sukuk issuance and things like that. Okay. Do you think that is feasible at this point in time, or are we just shooting for whatever.
We're in
we should say.
2025. I think I need to wake you up from your doubts. This is 2025, and a lot of technology and innovation is going on. And we're in a good position in Nigeria because we have a SEC that is actually waking up to shoulder a lot of responsibility in that area. There's a lot going on from even the authorities to support innovation with these types of products. So I think it's definitely a reality that these things can be. You can use blockchain technology to drive issuance of sukuks or other assets like that. It definitely helps for easy adoption by retail investors. I talked about the fact that the entry level is 10,000 naira. So with technology, with tokenization, or distributed ledger to make it efficient, those small amounts of money will easily plug in and be able to adopt and invest in those securities. So I think SEC is doing a very good job to support, and I think the ecosystem, in terms of fintechs, in terms of even the financial institutions that are issuing the instruments, are working towards that. I think is very possible in Nigeria. Nigeria is alive with this technology, and I was just checking it out recently. Dubai actually issued smart sukuks, so that's already a reality in Dubai. Somewhere around there as well, I think Bahrain or so, they launched a platform where you can actually issue sukuks using blockchain. So, I mean, if it can happen in those places, I don't see why it can't happen in Nigeria.
And you're confident that our regulatory environment is ready for something like that?
Yeah, I mean, I mentioned I'm impressed with how the SEC is approaching the markets, especially coming from the new ISA law that was signed into the rule that was recently signed. It speaks a lot about digital assets, innovation, even specifically addressing or providing guidelines for digital asset issuances. So I think the SEC is actually, the regulatory environment is encouraging, even holding up all of their responsibility with investor protection. They're still very much open to innovation, and market development. So I think the environment and the regulatory environment is ripe.
Okay. Yeah, I think one thing that I found interesting from our last interview was you were trying to picture a situation where the SEC, the regulators, and the players in the space come together to actually build. Yeah. So can you just reiterate that for the camera? Let's.
Oh, okay. Yeah. I mean, if I remember our conversation very well, but I think my idea was the fact that there's a lot of opportunity that that the Nigerian investment environment can actually take advantage of. The fact that SEC is now appearing to be more open and doing things to also show that they are supporting innovation, supporting technology, product development. The players themselves now need to also wake up, because I know that a lot of players in our space, capital market operators, fund managers, issuing houses, even fintechs, are used to the heavy hand of SEC. So everybody has more or less recoiled and just tried to tick the box and not just fall foul with SEC generally. So that has stifled innovation in a sense. So in a situation where players wake up to their responsibility to innovate more in an environment where SEC is actually encouraging them to do so within regulatory framework, obviously, there's a lot that can be achieved. There's a lot more new and innovative products that we'll see. There's a lot more market liquidity in terms of movement of cash and assets that makes it easy and improves investor confidence that can also experience. So, I mean, that was my idea. I think it's an opportunity that we can have in this current regulatory environment as well.
Yeah, I think an interesting question to ask is, with the current macroeconomic environment, inflation is at a very, very high level right now. How do we now balance risk and reward for the different asset classes? And looking at everything, what asset class would you say Nigerians should tilt towards, all things considered? And
yeah, great question. That's I mean, it's a real challenge for most investors in Nigeria, retail and institutions. So the first thing I'll say is I mean, the problem you're posing is simply the fact that the real return, when you compare inflation to where most of the assets, the risk-free assets are yielding, still has a gap that kind of just talks about negative real return. The first thing I'll usually say about that is it's better to invest than not to invest at all. First of all, something is better than zero. Whatever you do, make sure you're investing, but talk to a financial advisor to help you. You can talk to your asset manager, you can talk to your stockbroker. But that said, with inflation where it is now, you are better served if you have a blended portfolio. So again, I'm saying blended because different people have different risk appetite. Different institutions will have a different risk appetite than retail individual investors. So you need to identify exactly that, look at your objectives. But a model portfolio that you can look at in this environment to enhance your return should actually have equities and stocks in your portfolio. You can have up to 40 to 50%. It gives you, exposure to upside movements in share prices, given, the positive outlook that we're seeing in the macro environment and the companies that are listed on the stock market. Positives in terms of the FX situation being normalized and all of that. In your portfolio, you should also have fixed income instruments, like we mentioned, Sukuks. We should have a percentage of that in your portfolio. You should have T-bills, and there are lots of very high quality commercial papers right now as well that helps to improve or enhance the return you can have on your portfolio. If you have a very good blended portfolio with very good advice, you can actually achieve positive real return.
Awesome. So yeah, let's aim for the positive real returns with the blended portfolio. Thank you so much, Benga.
That's all we can take on this edition of Equity Merchants. If you enjoyed today's show, subscribe to Business Front TV for full episodes and catch our clip highlights on LinkedIn and X. I'm Chimgozirim. See you next week.